Has been interesting, just the impact of the markets and the Reserve Bank today. But it did say today it continues to plan to normalise Australian interest rates by increasing the cash rate by 0.5%, as we said, to 1.85%. Now, the RBA in its statement says it expects to raise rates further in the coming months, but importantly says it's not on a preset path. The RBA also upgraded its economic forecast today, raising its inflation outlook from 5.9% to 7.75%, in line with Treasury's outlook last week. Similarly, the Reserve Bank now says that economic growth this year will be 3.25%, down from its previous forecast of 4.2%. So these interest rate rises are going to slow the economy. So let's bring in here Gareth Spence, National Australia Bank senior economist. And Gareth, thanks for your time. You've got a forecast right now of the cash rate topping out at about 2.85% late this year. Is that a forecast you're sticking with?
That's correct. So today was pretty much bang on as we and many others expected with the 50 basis points. We think we'll see another 0.5 percentage point increase next month, and then maybe the RBA slows kind of that rate of increase in October and November down to 25 basis points, but then sort of, as you mentioned, kind of pausing to sort of assess as the data flow comes in and how rates are feeding through.
Okay, so these are pretty significant jumps. So we come from 0.1 to 1.85% on the way to your rate of 2.85%. So these rate rises have still got a significant way to go. How does the Australian economy, what sort of shape is it in to deal with these rate rises?
Look, we think it's in pretty good shape. So labour market data last month saw unemployment fall to 3.5%, a 50-year low. Means wages growth are kind of looking to pick up a little bit more strongly than it has. We know that households have built up quite big buffers of savings and mortgages. So I think for us, it's really the RBA shifting away from these emergency lows with quite a healthy economy, and it's a bit of an economist term, but normalise or neutralise kind of policies that we're not overheating, but we don't think they're going to push too hard back on the economy either. It's a little bit about tapping the brakes more than anything else.
And what about the statement today about the Reserve Bank being absolutely determined to crush this inflation? But it also noted there was, as it says here, a narrow path. Now, the path to achieve this balance is a narrow one and clouded in uncertainty. Explain to me what it means there about those uncertainties. Why is that path so narrow?
So I think the path's pretty narrow. I think we've seen a very rapid increase in rates, as you mentioned, from those emergency lows. We haven't seen rate rises for a decade, so kind of calibrating exactly what their impact is on the economy.
There's even suggestion we haven't seen rate rises of this magnitude for almost 3 decades.
That's right. So the strongest since 1994. I think it's important to remember where we've come from. But I think, the economy is kind of well placed to sort of deal with these.
So then talk to me about the narrow path. What's the narrow path? Why is that path so narrow? Because that implies that there's dangers on either side.
That's right. So I think it's a bit of an unusual scenario. So normally this kind of part of the cycle, rates are, kind of rising, we're at full employment and the RBA is working to bring down inflation. What's different this time is, we've got this very big global inflationary shock. And that's, we expect that to unwind. Where it, settles is pretty unclear, and how quickly that unwinds. So the risk for the RBA is, the longer inflation stays high, that feeds back into wage bargaining and then, further price increases. And that's something they certainly want to avoid. But as they noted in the statement today, is something we think is quite anchored. I guess trading that off, the other side of the path is, they want to hold on to the gains that we've seen in the labour market. We still expect pretty strong growth. They're not forecasting a recession, neither are we. So, the risk is going too far. Where is that neutral rate? We think, they're getting to about neutral of 2.5 and maybe a little bit further to kind of tap the brakes. But, certainly they don't want to push us into a recession or kind of...
See, that's the thing, and that's the narrow path, is a recession. And in fact, I went and spoke to the Treasurer last week about this, Jim Chalmers, and I asked him about his fears about the forecasts and about, what keeps him up at night thinking about these numbers. And he did say it was really the international shocks. But then the second thing he said was whether the forecasts are right. And now forecasting is notoriously difficult. The Reserve Bank is notoriously damaged its reputation, you could argue, for not having got forecasts correct. Is that an issue right now for all economists, or indeed for the Australian economy?
I think it's true of all economists. I think we want to be pretty humble in how we approach these things. But I think, that's right. Like I said, normally we don't expect inflation to come down on its own accord. We haven't seen unemployment of 3.5% for almost 50 years. So we're not quite sure how quickly wages pick up and then feed back through to kind of the wage bargaining process, how things play out in terms of the global front. We keep looking and we keep thinking that inflation may have peaked, and then we see, 9.1% in the US.
Yes.
And pretty high elsewhere.
But there's your danger, isn't it? It's always the wages that are the danger. If all of a sudden the community expectation, seeing prices rise, they say, well, actually, I need to keep up. I need a higher wage, or unions say that, or, it's one of these fights that might come. And so if it's suddenly expected that wage rises are coming, that makes it harder to get the inflation out of the society. That's where interest rates sometimes might have to go higher to really push it out, squeeze it out.
And that's spot on. So I think for now, our assessment and the RBA's assessment is that those expectations haven't got out of control. There's certainly the risk. And I think, by acting quite swiftly, so moving from that record low emergency 0.1%, back to something more neutral in sort of the twos, it is part of the signalling that, they will target inflation and they will work to bring it back to that 2 to 3% over time.
Well, it was certainly the message there today from the Governor, Philip Lowe. Gareth Spence, Senior Economist with the National Australia Bank, many thanks for your time on the program.